Top Fed official signals interest rates to stay on hold at September meeting. This is a Financial Times story. Vinny, I'm going to come to you on this one.
Finally, I'm just sitting here waiting with these numbers.
Christopher Waller, a Federal Reserve official, suggested that the central bank is likely to keep its benchmark interest rate unchanged at the upcoming September meeting, citing recent economic data as not warranting imminent monetary tightening. Waller emphasized there's nothing that is saying we need to do anything imminent anytime soon. Waller's remarks echoed Federal Reserve Chair Jerome Powell stands at Jackson Hole, Wyoming symposium, emphasizing a data-driven approach. Recent labor market reports indicated a slowing demand for workers in the U.S., prompting the Fed to closely monitor inflation indicators. Despite improvements in inflation data, Waller remained cautious, emphasizing the importance of sustained trends rather than isolated reports. Tom.
Mm-hmm. Yeah, so the Fed's going to get together September 19th and 20th, but Jay Powell will not be going upstairs to pound the cheerleader. She's going to get a break. They're not going to raise rates.
Jesus.
It's not going to happen. However, on Halloween, Jerome Powell's going to dress as somebody, and they're going upstairs. And unless some of these soft economic things that we're seeing, we're probably going to get a quarter-point increase on October 31st. And there's a lot of people, including me, analysts, that believe that will be our last increase. And then we're got to get through the winter, see how Black Friday and fourth quarter goes and everything like that. But I'm hoping there's none on October 31st, but it looks like with the softness, we'll probably get a quarter point, but nothing in the next 2 weeks, which is a good thing.
When will be the first decrease?
I think the first decrease, I'm with the consensus on this.
February?
The bigger banks is probably April, right at the beginning of second quarter, is you get a quarter point back. But here's what it needs, and it's kind of bad. What it needs is softer consumer spending so it doesn't drive inflation prices, and it needs a little bit of softness in the labor market. So some layoffs, and we're seeing some of those. We need a little bit more softness in the labor market to keep wages down a bit.
How much of what Amazon does on Black Friday and holiday season is going to kind of tell us where consumer spending is and how it's going to dictate interest rates?
Well, I happen to be very interested in how the hell the U.S. consumer is going to make Black Friday crazy when they've now drove their consumer credit cards up to $1 trillion.
Brilliant.
How do they go nuts on Black Friday this year if 30 days ago consumer credit hit the largest total credit balance of all time?
Yeah, I was just going to go there if you follow the math. So let's just follow some of the numbers here for a second. So the Fed funds rate, right, is what? 5.25%, 5.5%, right? So that's the rate at which the Fed lends money to or gives money to the banks. And then the prime rate, which is the number that banks will use to basically disperse money to the regular people, is usually around 3% higher than the Fed funds rate. So basically you're talking Fed fund rate 5.25%, 5.5% to the prime rate, which you would receive or businesses would receive at about 8.5%.
There's your mortgages.
Okay, there's your mortgages, exactly. But you brought up the best point. The average person out there, you talked about that credit card debt just passed $1 trillion. Student debt's already done it. Auto loans are already there. Mortgages are already 10 trillion, whatever the number is over there. But speaking of credit card debt, you know the prime rate being 8.5%. Do you know the average credit card rate in America today? The average. Take a guess.
24?
19.5.
19.9%. 20%. Highest of all time was 17% last year. So they're breaking records. These are the type of records that you want to be breaking if you're an average consumer. So it's very important. Just pay attention to the interest rates. There it is right there. 20.9, 21% if you just want to round up. Okay, listen, if you're trying to make money investing, a good decent rate of return would be what? 10%?
9.
10%, that's what the stock market pays over time. You're losing money going the opposite way when you're trying to go this way. It's disastrous and it's killing your wealth.
Guys, listen, because I don't want to show off, Pat, and get into all the finance stuff, but everything that you and Tom said, I concur. So that's
great.
Thank you for that.
And your constituents agree.
My constituents are 100.
We appreciate that. We appreciate.
Do you know the cap on credit card debt? What like the highest they can charge you? Do you know what it is?
No clue.
30%.
Wow.
That's like that's all that they're allowed to. So right now
used to be higher.
Let's start a credit card company.
Yeah, well, that's a big business to get into. But what they're starting to do is the level of regulation and scrutiny right now with Visa, MasterCard, the world they're dealing with, it's not what it used to be. Because a lot of guys see these numbers and they're like, let's go into the credit card business. It's not what you think it is. There used to be a lot of money in it years ago. They've kind of, regulations hurt them a little bit. It's still profitable, but it takes a lot more to get into it.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.